Welcome to vTalkInsight, Risk Sentiment Daily for March 11th, 2026. Middle East energy disruption is colliding with surprisingly resilient risk assets, and that tension is defining today's trading landscape. Let's unpack how that mix of shock and resilience is shaping risk sentiment across equities, credit, and oil. Across assets, today's picture is best described as cautiously risk-off. The headline risk backdrop remains heavy, but there are enough signs of resilience to prevent an outright capitulation. Estimates now put the probability of a severe market meltdown this year at around 35%, and the chance of a 10 to 15% correction is put at a similar level. That is a material step up in perceived tail risk, even though day-to-day price action looks more measured. Equity moves have been relatively contained outside of the most exposed sectors, with the S&P 500 recently posting only a small daily loss while the VIX sits in the mid-20s. That volatility index has eased back from the mid-30s, so some of the panic premium has come out, but we remain far from a low volatility regime. Compared with the decisively defensive tone earlier in the week, this feels more like an uneasy pause than a genuine return to risk-on. Flows underline that defensiveness. There has been strong demand for high-quality fixed income and tight spreads in investment-grade credit, while riskier parts of credit and cyclical equity sectors have come under pressure. At the same time, we continue to see sharp intraday swings in oil and rates and rising correlations across equity sectors, pointing to a market driven more by macro headlines than by stock-specific stories. Against that backdrop, the balance of evidence still tilts toward a risk-off stance, but with important pockets of opportunity and resilience that we will come back to. The most powerful bearish force remains the Middle East energy shock and geopolitics. The Strait of Hormuz is effectively closed to normal commercial shipping, with around 200 vessels trapped and Gulf traffic largely halted. Roughly 6% of global oil supply is offline as producers cut output or run into storage and tanker constraints, and attacks on tankers and infrastructure, including a precautionary shutdown at the UAE's largest refinery, underscore how vulnerable the region's energy system has become. Oil prices reflect that stress. Brent has swung from nearly $120 to below $90 in a single session, and intraday ranges of more than $30 have become possible. Options markets suggest a $5 to $7 per barrel risk premium embedded in prices, and many analysts see $80 as a potential floor as long as the blockade persists. At the same time, jet fuel costs have spiked by around 150% in a week, threatening airline margins where fuel can represent up to 40% of expenses. Geopolitical uncertainty is being reinforced by policy ambiguity. The definition of Iranian surrender has effectively been made discretionary, leaving the timing of de-escalation in the hands of political leaders and making it hard for markets to price an endgame. Strategic reserves could release up to 400 million barrels, but that only covers a few dozen days of current supply losses and would likely need to be deployed quickly rather than gradually. There are glimmers of relief, including political signals aimed at keeping the waterway open and talk of naval escorts, which helped trigger a recent 6 to 7% drop in crude and a rebound in European equities. However, with no firm timeline for restoring normal flows, the energy shock and geopolitical risk premium remains central constraints on risk appetite. Layered on top of the shock itself is rising stagflation risk and policy uncertainty. Scenario work suggests that if oil holds above $100 for several months, developed market growth could be shaved by around 0.5 percentage point and inflation pushed up by roughly 1 percentage point. Even at $90, estimates point to a similar drag on global growth, with higher fuel costs acting like a tax on households and businesses. The microdata are starting to reflect that squeeze. Small business real sales growth has slowed to under 1% recently and is projected to be well below historical norms next year, while rising input costs, including a 50% year-to-date jump in oil and higher gasoline prices, are leading more than a third of small firms to plan price hikes. For households, higher fuel and food prices are diverting tax refund spending from discretionary items toward necessities, and lower-income consumers with depleted savings look particularly exposed. This mix leaves central banks in a difficult position. Persistent wage growth above 3% and energy-driven inflation complicate a quick return to a 2% target, and several observers now expect the Federal Reserve and its peers to delay rate cuts relative to earlier expectations. In Europe, where economies are more reliant on imported energy and inflation pass-through is faster, front-end yields have become especially sensitive to geopolitical headlines, and there is growing talk of policy divergence between the Fed, which may eventually cut, and the European Central Bank, which might have to hold or even tighten if energy inflation remains elevated. This uncertainty over the path of real rates and growth is a key reason why the correction and meltdown probabilities have risen so sharply. A third important bearish driver is growing stress in private credit markets. Defaults in U.S. private credit have climbed to nearly 6% over the past year, the highest level since data began in 2024, and leveraged loans are showing mounting strain. Loan exchange-traded funds have seen close to $2 billion of outflows in a month, signaling investor anxiety about credit quality and recovery values. Liquidity is becoming a focal point. A major global asset manager has enforced withdrawal caps on a private credit fund as redemption requests picked up alongside the broader risk-off move and Middle East tensions. There are also increasing policy concerns about the suitability of private equity and private credit in retirement accounts, with regulators highlighting the risks of locking retail investors into illiquid structures they may not fully understand. Strategists warn that stress is most likely to surface in leveraged loans and private credit where underwriting standards were weakest, and we are already seeing isolated, controlled implosions. For now, the stress looks concentrated rather than systemic. Investment-grade credit spreads remain historically tight, under 100 basis points, and capital markets are open and functioning, with very large, high-quality issuers able to refinance and raise funds at scale. There is also no clear evidence of broader banking system fragility, and central banks have more liquidity tools than in past crises. The risk is that a sustained inflation shock from high oil eventually forces a sharp repricing in spreads and funding costs, turning today's isolated issues into a broader drag on risk assets. Set against those headwinds, equities have shown notable resilience and selective risk-on pockets. Despite the effective closure of a key global shipping choke point, extreme oil volatility, and a $6 trillion wipeout in global equity value over the past week, broad indices have not yet moved into outright freefall. Outside of the sectors most exposed to higher energy and shipping costs, such as airlines, materials, and some consumer names, declines have generally been modest. Recent price action illustrates this two-way behavior. European equities have rebounded by around 1.7%, ending a four-day losing streak as oil prices and bond yields eased on hopes of a shorter conflict and policy support. Banks and travel stocks have led those gains, with banking shares up more than 3% as lower yields provided relief from earlier losses. Volatility has also stepped down from extreme levels, with the VIX dropping from roughly 35 to the mid-20s, signaling a partial recovery in risk appetite even as uncertainty remains high. Importantly, this resilience looks selective rather than broad-based. On down days, market breadth has been weak, with only a couple of S&P sectors in positive territory and the rest in the red, and a recent pullback in crude did not translate into sustained equity gains. One strategist still expects U.S. equities to finish March in positive territory and even sees room for the main index to grind toward the 7,300 area before any deeper bear market later in the year. That kind of view captures today's tone well. Risk appetite exists, but it is tactical, valuation aware, and highly sensitive to incoming geopolitical and macro news. Another key support for risk sentiment is strong technology and AI earnings momentum. Large technology firms are in the midst of a powerful capital expenditure cycle reminiscent of the 1990s as they build out AI infrastructure and related services. Taiwan's semiconductor manufacturing has reported sales growth of around 30% in the first 2 months of the year, and analysts expect a further 33% increase for the first quarter, underscoring robust demand across the AI supply chain. U.S. tech earnings more broadly are growing close to 30% year-on-year, and that strength is a major reason some active investors maintain a constructive stance on selected growth names despite macro volatility. Individual stories reinforce the theme, but also highlight risks. Oracle delivered better than expected revenue and raised its medium-term outlook, driving a sharp move higher in the share price as investors gained confidence in its cloud infrastructure trajectory. At the same time, Oracle's credit default swap spreads have widened to levels last seen in 2009, reflecting concerns about funding an aggressive AI build-out without over-leveraging the balance sheet. Meanwhile, the software sector faces an innovator's dilemma as business models shift from seat-based software toward usage-based, tokenized services, and attempts to layer AI surcharges on top of years of price hikes risk customer pushback. Overall, tech and AI remain powerful engines for earnings and long-term growth expectations, but the dispersion of winners and losers is likely to stay high. The third constructive driver is supportive demand for high-quality fixed income. Despite headline volatility and the energy shock, investors have allocated more than $100 billion into bond exchange-traded funds in the first 2 months of the year, the strongest start since 2007. Flows have been concentrated in treasuries, investment-grade corporates, and inflation-linked and short-duration products, reflecting a clear preference for quality and liquidity. Investment-grade credit spreads remain historically tight, under 100 basis points, and capital markets are open, with mega-cap issuers such as leading technology companies able to place record-sized multi-currency deals that fund strategic AI investment while still finding ample demand. This demand helps anchor the system even as yields move around. Bond market volatility has picked up and long-dated treasury yields have risen as markets juggle higher inflation expectations against weaker growth risks from expensive energy. Traditional 60/40 portfolios are under review as stock-bond correlations remain elevated, pushing allocators toward additional diversifiers such as commodities and gold, which many expect to trend higher over the coming years. Even so, the combination of attractive yields, resilient market plumbing, and central bank liquidity tools leaves high-quality fixed income as a core ballast in many portfolios, cushioning some of the downside from the more severe risk scenarios we discussed earlier. To sum up, risk sentiment today is still cautiously risk-off, anchored by the Middle East energy shock, rising stagflation risk, and emerging stress in private credit, even as equities, technology earnings, and high-quality bonds provide important stabilizers. The key watch points from here are any credible moves to reopen Gulf shipping lanes, the trajectory of energy-driven inflation and wage growth, early signs of widening credit spreads beyond the most leveraged segments, and whether equity resilience broadens out or remains narrowly focused. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.